These are some of the scariest events that could possibly be happening in the market at the same time. Today, you can see almost every single yield was up in the US after the FOMC happened today. And the biggest reading for this was what Fed Chair Powell said after his report, where they didn't see inflation coming down as much as they hoped, and they kept rates still, even though they see almost zero job growth in the private sector. One of the reasons for this horrible, worrisome yields rising and pricing and inflation is the GSG going up because oil prices, look at them, they're around $97 right now, up from around $50 they had them around in January. Almost a 100% rally in this. And if you know anything about the market and the GSG index rising like this precedes areas of huge inflation. And we know that whenever we get a lot of inflation, that means we're going to get a lot of rate hikes instead of rate cuts, and the discount rate on equities are going to go down. And we also know that all the rich people have been holding up a lot of the spending in the market right now. And what are they in? They're heavily invested in tech and a lot of equities. So if those equities end up losing value, that could lead to catastrophic returns in the market and the market going straight down later this year if this holds up and the war possibly keeps going on and these indexes stay up. The good part of today was, though, Powell came and said that he thought that inflation from the oil and inflation from the tariffs is transitory. And even though we got a PPI print of hot with core PPI and non-core PPI, core PPI was about up 0.2% month over month and year over year than they thought with expectations, and then the non-core was up about 0.4% higher than they thought expectations were going to be. Let's just take a little clip here of Jerome Powell speaking about the interest rates, what he thinks is going on in the labor market, and those transitory inflation, which is a good thing that we heard today.
Shift from other parts of it may take quite a while for an individual tariff to take its full effect. But once it's had that effect, then the question is, isn't it just a one-time price increase? So we actually look at it, all of the announcements and what you get from all that. You see sort of for each one of them, there's a time period, and then it's fully in. So if there are no new tariff announcements, and we don't know that, but let's assume there are no major new tariff announcements, inflation from goods should peak in the first quarter or so, right, or roughly. We haven't been able to predict this with any precision. No one is, but call it the first quarter or so of next year should be the peak. And from here, it shouldn't be big. It should be a couple tenths or even less than that. We don't really have precision on this, and after that, again, if there are no new tariffs that are being announced that will take 9 months to get fully in, and 9 months is also an estimate, then you should start to see that coming down in the back half of next year.
And I want to see if I could address sort of the elephant there. The president's been talking openly about a new Fed chairman. Does that hinder your current job right now?
So from what we just heard from Fed Chair Powell, they're saying he believes that these tariffs and even the gas inflation he said later in the videos are transitory. So that's good that they're going to be a one-time price increase right now, and then eventually you're going to get that inflation rate coming down, which is going to open the door for the Fed to end up cutting rates later. But for that to even happen or anything, the inflation has to come down. So they're going to hold still until this happens. So anything possibly happening in the GSG or because of oil could delay those cuts even later in the future. Traders are now saying that it's going to be September rate cuts they're predicting, which could be too late for this economy. That if you actually look at this article by this man over here, he said unemployment has rose up to 4.2% to 5.4% whenever you adjust for labor participation rates and people not trying to look for jobs. Because if you have to think, unemployment is taken of the amount of people actually trying to look for jobs. Whereas if you maybe have been trying for a year or two to look for a job and you can't find one, you might just take your unemployment benefits and not be looking for a job actively at that time. So that an unemployment rate can actually look lower than what it is. So whenever you're looking at the employment rates, you always need to take in for the labor participation rate. So if you see low unemployment and a very high labor participation, you know you're in a strong economy, good unemployment. But if the labor participation rate is also low, unemployment is low, there's some red flags because are people not looking for a job, and could employment rate really be higher there? So that's just some things to take into account whenever you're looking at this. There's always metrics behind the metrics to really take in hand with how they count, and that's why it's important to know all the definitions of everything and what it means. So just another way here of looking at all this stuff that I'm going to show you is a little quick trick. To find out what the inflation expectations of the market is, you kind of can go and take the 10-year treasury which is about 4.269, and you take it minus the tips. So that's giving you an inflation of 2.4, 2.5 is what the market is pricing as a 10-year average. Now you are getting paid a little bit of the premium on the yield, so maybe it's around 2.3, 2.4, 2.2-ish, just with that, just because if you're locking your money up for 10 years, right, you're going to want a little bit extra to be paid because you can't access that money. So that's what you always have to think. But this is a pretty good way to get a rough estimate of what the market is going to be pricing in for inflation and to know. And then another great even way to predict what the federal funds rate is going to be is using the 2-year yield. Because look what the 2-year went down. Whenever people were pricing and rate cut way earlier this year, it was down to 3.5. Now it's up to 3.80. And that's almost always going to be right around that federal funds rate, what you are. So the 2-year is really going to be signaling what is the Fed going to do. And that can tell you if they have room, if they're going to be able to cut or if they're not going to cut that meeting. So it's something pretty important to look at because bonds never lie compared to equities. Bonds are almost always right. You're going to see those credit spreads break out before a dispergence. And even if you look at this, so the Fed rate started going down in September 2024. The 2-year just started pricing that in about a little bit earlier, right here, to get it down those rates under that 5. So they're kind of starting to price in that. So the 2-year is something you can look at to really see what are the expectations for what the Fed's going to start doing and they're lowering based on all these yields in the market. So for example, the other date came out, right? Even today before, let's just go look at the 10-year, what people thought was going to happen, inflation, right? Like I said this morning, what happened? PPI came in very high. It beat the expectations of analysts, meaning that the PPI is important because it's the price that gets passed down to the consumers later because the producers see that price first. So if that comes in high, you think it's going to go into PCE and CPI down the line. So basically, you've seen this CPI and PPI made it go up. These, you see the 10-year rows. So that's what you can tell. If you're not sure what everything means on inflation, if it's good data or bad data with the market or jobs, you can kind of look at the yields and see what are they pricing in. If the yield goes up, it means they're pricing either hikes or no cuts or higher inflation expectations, usually with the 10-year. And if it goes down, they're starting to price in more cuts in the market. And people are starting to try to take those yields at those prices and push it down because they expect the interest rates are going to be going down in the future. So they would rather lock in the yield at that higher price. So that's just some quick stuff to look at in the bond market and how you can use that to actually find out the policy expectations because those traders understand stuff. And it's just very important to understand and be listening to the FOMC meetings and understand what the Fed chair is saying. Are they can be a dove and say there's more problems in the labor market, or they can be a hawk and say there's more problems in inflation. So all that's just something to keep into account of whenever you're making your investments, because obviously as soon as rates start getting hiked, that's whenever equities fall because that discount rate goes down, credit tightens, lending standards aren't there as more defaults happen. So your money's not getting paid as much for these companies, and yields whenever are inverse to the price of bonds. So just that's something you got to just keep in track and what to do because you kind of need to know what the Fed's thinking about doing in the future because the market's going to be pricing this in. So if you see inflation's actually easing or something, then you kind of know, hey, I want to be taking more right now because we're going to get interest rate cuts coming up. So thanks guys for watching.